All right, remember the controversial border adjustment tax, or the BAT, the one that House Ways and Means Committee Chair Kevin Brady and Speaker Paul Ryan liked? Those same Republican leaders tossed it aside back in July while they were coming up with their version of a tax reform plan. You know, they needed to compromise and do a little horse trading, right? Will the elimination of the state and local tax deduction, known as SALT, could that be on the chopping block next? In a Fox Business exclusive, we bring in the godfather of the border adjustment tax, UC Berkeley economics professor Alan Auerbach. He's also the former president of the National Tax Association. Good to see you, Professor. What about that? Do you think that SALT, which is causing real stomach aches in high-tax states, California, New York, New Jersey, where there are a lot of businesses that have a lot of jobs, is that going to be one of those so-called chips on the backgammon table that could be moved around?
Absolutely. On the other hand, it raises a lot of money for them, and that's really the box they're in, especially in the Senate, where they have to face the Byrd rule after 10 years and have all the individual tax cuts expiring as it is. It would make a lot of sense if they are thinking of phasing state and local tax deductions, mortgage interest deductions out, to do it very gradually to allow adjustments in the economy, to avoid big disruptions in the real estate market. But of course, given their 10-year budget window, delaying these kinds of things means they don't raise as much revenue, and then they have to come up with it somewhere else.
Well, I applaud them for at least trying to find out a place to get revenue. You're the tax brainiac, Professor. Do me a favor. Tell me what else they could trade out with the state and local tax deduction that might get the 1.3 trillion number right up there.
Well, of course, you know, and you've already referred to my favorite proposal, and that would have raised a lot of revenue. Yeah. And it would have been a pretty big change, and I can understand why they've moved away from that. Although I should add, they haven't moved completely away from it.
You're talking about the border adjustment tax.
Yes, they've got the House has an excise tax proposal. The Senate has a minimum tax proposal. Those are both unrelated party imports, which would function like modified border adjustment, not as well in my view, but not as big a change from the current system. But there really aren't any secret caches of revenue out there. They've identified the standard places to get the revenue, and of course they're all painful. About the only other alternative would be not to have as big a reduction in the corporate rate, which they're committed to go to 20% on that.
Can I ask you about that 20%?
Sure.
If they raised it, one of the senators on the GOP side had said maybe 22%. Would that, in the aggregate, be enough to supplant the state and local tax deduction revenue?
There's a lot of money for every percentage point. I couldn't give you the exact number, but my guess is if they really want to get a chunk of revenue from raising the corporate tax rate back up, they're probably going to be more in the neighborhood of around 25%. And of course, if you go much higher, then there's going to be a lot less enthusiasm for what they're doing, because the whole point of doing this is to lower business taxes.
Can I ask you whether you think that the repatriation holiday for profits that are parked overseas, the likes of Apple and Intel and so many of these big companies, they don't want to be double taxed bringing it back in. If this tax holiday is permanent, do you get the sense that these companies will come in gung-ho back to the U.S. with their profits and start hiring and building? Because when President Bush, GW, did that one-time tax repatriation, the money repatriated, look what happened. There were a bunch of layoffs. Pfizer, Merck, Hewlett-Packard, Ford. They took the money and they basically did share buybacks, or they raised their dividends to make their shareholders happy. Okay, fine. But they also laid off workers. Would this work this time if it were permanent?
Well, if it's permanent, they're not going to be in a rush to bring the money back the way they were in 2004, where they had a one-year window. There may be some money coming back. I wouldn't expect major effects on business investment in the U.S. from that, primarily because the companies, like the ones you just mentioned, are quite liquid. They've got a lot of cash. They've got a lot of cash offshore. They've got a lot of cash in the U.S. And they also have good access to capital markets. So they're not turning down investment opportunities because they have a lack of cash.
All right. My last question. Does this mean that SALT is it, that the state and local tax deduction elimination is? Do you see that actually coming to pass?
I don't want to hear this. I think if they are successful in passing a bill in the Senate and then going through conference, there's going to be some cutback in those taxes, whether it's the full cutback that's in the Senate bill, the partial cutback that leaves in a partial deduction for property taxes in the House bill, or something additional. I don't know.
Thanks for that lump of coal early in the stocking.
Sorry.
Thank you so much. Good to see you. Happy Thanksgiving, Professor.
Same to you.